Since its inception about 50 years ago, D&amp Insurance has evolved into a family of products responding differently to the needs of publicly traded companies, privately held businesses and not-for-profit entities and their respective board members, officers and trustees. Directors and amp officers liability, executive liability or management liability insurance are essentially interchangeable terms. However, insuring agreements, definitions, exclusions and coverage options vary materially depending upon the type of policyholder being insured and the insurer underwriting the risk. Executive liability insurance, once considered a necessity solely for publicly traded companies, particularly due to their exposure to shareholder litigation, has become recognized as an essential part of a risk transfer program for privately held companies and not-for-profit organizations. Optimization of protection is a common goal shared by all types of organizations. In our opinion, the best way to achieve that objective is through engagement of highly experienced insurance, legal and financial advisors who work collaboratively with management to continually assess and treat these specialized enterprise risk exposures. Private Company D&amp exposures. In 2005, Chubb Insurance Group, one of the largest underwriters of D&amp insurance, conducted a survey of the D&amp insurance purchasing trends of 450 private companies. The significant percentage of respondents gave the following reasons for not purchasing D&amp insurance. Did not see the need for D&amp insurance. Their D&amp liability risk was low. Thought D&amp risk is covered under other liability policies. The companies responding as non-purchasers of D&amp insurance experienced at least one D&amp claim in the 5 years preceding the survey. Results showed that private companies with 250 or more employees were the subject of D&amp litigation during the preceding 5 years, and 20% of companies with 25 to 49 employees experienced a D&amp claim. The survey revealed 43% of D&amp litigation was brought by customers, 29% from regulatory agencies, and 11% from non-publicly traded equity securities holders. The average loss reported by the private companies was $380,000. Companies with D&amp insurance experienced an average loss of $129,000. Companies without D&amp insurance experienced an average loss of $480,000. Some common examples of private company D&amp claims: major shareholder-led buyouts of minority shareholders alleging misrepresentations of the company's fair market value, purchaser of a company or its assets alleging misrepresentation, sale of company assets to entities controlled by the majority shareholder, creditors committee or bankruptcy trustee claims, private equity investors and lenders claims, vendors alleging misrepresentation in connection with an extension of credit, consumer protection and privacy claims. Private company D&amp policy considerations. Executive liability insurance policies for privately held companies typically provide a combination or package of coverage that includes, but may not be limited to, directors and amp officers liability, employment practices liability, ERISA fiduciary liability and commercial crime/fidelity insurance. D&amp policies, whether underwritten on a stand-alone basis or in the form of a combination type policy form, are underwritten on a claims-made basis. This means the claim must be made against the insured and reported to the insurer during the same effective policy period, or under a specified extended claims reporting period following the policy's expiration. This is a completely different coverage trigger from other liability policies such as commercial general liability that are traditionally underwritten with an occurrence trigger, which implicates the insurance policy that was in effect at the time of the accident, even if the claim is not reported until years later. Side A coverage, which protects individual insureds in the event the insured entity is unable to indemnify individuals, is a standard agreement contained within many private company policy forms. These policies are generally structured with a shared policy limit among the various insuring agreements, resulting in a more affordable insurance product tailored to small and mid-sized enterprises. For an additional premium, separate policy limits may be purchased for one or more of each distinct insuring agreement, affording a more customized insurance package. Also, policies should be evaluated to determine whether they extend coverage for covered wrongful acts committed by non-officers or directors, such as employees, independent contractors, leased, and part-time employees. Imputation of knowledge and A&P. Severability coverage can be materially affected if an insured individual has knowledge of facts or circumstances or was involved in wrongful conduct that gave rise to the claim, prior to the effective date of policy under which the claim was reported. Policies differ as to whether and to what extent the knowledge or conduct of one bad actor may be imputed to innocent individual insureds and/or to the insured entity. Severability is an important provision in D&amp policies that is often overlooked by policyholders until it threatens to void coverage during a serious pending claim. The severability clause can be drafted with varying degrees of flexibility, from partial to full severability. A full severability provision is always most preferable from an insured's standpoint. Many D&amp policies impute the knowledge of certain policy-specified senior-level officer positions to the insured entity. That imputation of knowledge can operate to void coverage that might have otherwise been available to the insured entity. M&AMP entail coverage considerations. The claims-made coverage trigger is critically important in an M&AMP context where contingent liability risks are inherent. In these contexts, it's important to evaluate the seller's policy's options to purchase a tail or extended reporting period for each of the target company's policies containing a claims-made trigger. A tail coverage option allows for the reporting of claims alleging wrongful acts that occurred during the expired policy period, yet were not actually asserted against the insured until after the policy's expiration, but instead were asserted during the extended reporting or tail period. An acquiring company's insurance professional should work closely with legal counsel's due diligence team to identify and present alternatives to manage contingent exposures. What a director or officer doesn't know will hurt them. Directors and AMP officers' liability insurance policies were originally created solely to protect the personal assets of the individuals serving on public company boards and executive officers. In 1992, one of the most prominent D&amp insurers led a major transformational change in D&amp underwriting by expanding coverage to include certain claims against the insured entity. Entity coverage for publicly traded companies is typically restricted to securities claims, while privately held companies and not-for-profit organizations benefit from more comprehensive entity coverage because they lack the public securities risk exposure of publicly traded companies. The claims-made coverage triggered D&amp policies are universally underwritten on a claims-made basis. This translates to an unequivocal contractual requirement that the policyholder report claims made against an insured to the insurer during the effective policy period. The only exception is in the case where an optional reporting tail is purchased which affords the insured the ability to report claims during a specified extended reporting period, as long as the wrongful act occurred during the effective period of the immediately preceding policy. Defense D&amp policies issued to public companies generally contain no explicit duty to defend, and some require the insured to select from a pre-approved panel of pre-qualified defense counsel. In contrast, many private Company D&amp policies do contain the provision placing the defense obligation squarely upon the insurer, and still other policies contain options allowing the defense to be tendered by the insured to the insurer within a specific period of time. Some D&amp policies contain defense cost provisions that require an allocation or sharing of the defense costs between the insured and insurer, based upon a determination of covered versus non-covered allegations. Settlement hammer D&amp policies typically contain a settlement hammer provision. This clause operates to limit an insurer's obligation to indemnify in the event the insured refuses to consent to a settlement that is acceptable to the insurer. Some policies may express the amount the insurer will pay for covered loss under this circumstance as a percentage of the ultimate covered settlement or judgment. Other D&amp policies may limit their economic exposure to the amount for which the case could have historically settled, but for the insured's refusal. Regulatory proceedings and investigations. Most D&amp insurance policies afford qualified protection against regulatory and governmental investigations, administrative or regulatory proceedings, and criminal proceedings. Policies often require the proceedings to be directed against a natural person insured, to be commenced and maintained in a manner specified in the policy, such as a formal order of investigation, and only for policy-defined defense expenses incurred after the issuance of a formal order or an indictment. D&amp policies' definitions and other corresponding provisions and exclusions vary, and should be carefully evaluated to determine whether they encompass informal investigations from the time a subpoena is received, or from the time an insured person is identified in writing as a person against whom charges may be filed. Learning the ABCs and Ds of D&amp coverage. The three main insuring agreements found in public Company D&amp policies are typically referenced as Side A, B, and C coverage. They are sometimes supplemented with an optional coverage D. Side A coverage, individual insured coverage. Side A coverage, also known as the non-indemnifiable loss insuring agreement, provides coverage to individual officers and directors against claims for their policy-defined wrongful acts in their official capacities, under fairly rare circumstances in which the insured entity either cannot or will not provide indemnification. The policy's Side A coverage for non-indemnifiable claims against directors and officers almost universally provides that no retention is required to be paid by individual insureds. A separate Side A limit may be available in addition to the traditional D&amp policy's aggregate limit of liability. Side A excess. D&amp policies have become more commonplace in the past several years, and certain Side A excess policies may also offer difference in conditions DIC coverage that generally provides a feature of dropping down to respond to claims either not paid by the primary or underlying D&amp policy insurer, or in the event indemnification is unavailable from the insured entity, the underlying limits are eroded by covered claims against the entity, or the underlying D&amp insurers deny coverage to the directors. Some Side A policies are underwritten as non-rescindable by the insurer. Purchasers of this coverage should also consider, if available, an option for reinstatement of policy limits for the outside directors, in the event of premature policy limit exhaustion. Side B coverage. Corporate reimbursement coverage. This insuring agreement reimburses the insured entity for covered loss under claim circumstances where the corporation is indemnifying its directors and officers. This provision does not afford any coverage to the insured entity for its own potential liability, and is subject to a self-insured retention cert that must be paid by the insured entity before an insurer will make any payments. It's important to know that many insureds do not realize they are contractually obligated to obtain the insurer's prior consent to incur costs and expenses, and only those costs and expenses approved in advance by the insurer will be deemed to have satisfied the insured entity's cert obligation. It's important for policyholders to understand they run the serious risk of losing some or all of their otherwise available coverage if they incur legal expenses prior to reporting the claim, or if they enter into negotiations or reach a settlement agreement in principle without the insurer's prior knowledge and consent. Side C coverage. Entity coverage. This insuring agreement affords coverage to the publicly traded insured entity only for its own liability and is typically restricted to coverage for securities-related claims. Securities claims is a policy-defined term, encompassing only claims arising from the insured entity's own securities. Privately held companies and organizations are afforded substantively different coverage under this insuring agreement. Side D coverage. Outside entity insured person coverage. This insuring clause is available as an option on most D&amp policies. It provides coverage to designated insured persons for their liability as a result of their membership on an outside entity board. This coverage applies on a double excess basis, meaning it is triggered after the exhaustion of any indemnification provided by the outside entity to the outside entity director, as well as any insurance coverage available from the outside entity. Traditional D&amp policies typically extend automatic coverage to insured individuals who are designated by the policyholder to participate as a board member of a not-for-profit organization.